JP Morgan shares are up over 40% over the last year, and even year to date are up nearly 22%. And then when we look at JP Morgan, technically, it is in an area where things typically reverse. So if you're like me and you hold your JP Morgan shares, you're wondering right now, after the company reported their Q2 earnings, is it actually time to sell? Maybe not your whole position, but a part of your position in JP Morgan, or do you stick around and wait for those dividend payment increases, which the company telegraphed on their earnings results? We'll talk about that and more on today's show. What is going on, investors? Hopefully you guys are doing well out there. Earnings season has begun, and we got JP Morgan. We always kick it off with JP Morgan. Always seems like on a Friday. This company is the first to report. We'll obviously get mega cap tech software for the rest of the month. But we've got to look at JP Morgan. They announced their Q2 earnings before the bell. Revenue coming in at $50.2 billion. Not a lot of companies putting up that type of revenue, and that was 21.5% growth. This is not a tech company. This is one of the oldest and largest banks in the world. 21.5% growth. They beat expectations by $4.5 billion. Wall Street was expecting a number closer to about $45 billion. The high-end estimate was $50, so they came in way above that at $50.2, but the devil is in the details, folks. This is not everything as it seems in terms of revenue and certainly profits with JP Morgan. We'll get to that in a second. I do want to focus a little bit on the forward estimates as they start to normalize with JP Morgan, kind of low single-digit growth for the back half of the year and into next year. Here's potential upside for JP Morgan, but basically low to negative growth out into 2025 for this company. So you're going to turn from pretty solid revenue growth, even low single digit for this company is really solid based on how efficiently they run things. We're going to move to like negative to 0% growth going forward. And then you obviously have the drop in interest rates potentially coming as soon as September. That could impact some interest income that the company earns, but it also could spur some more loan growth. Now, speaking of that, the company is seeing robust dialogue in the equity capital markets, essentially the IPO markets. Also with M&A, that could be a big story as we move into the election cycle. Certainly after the election cycle, the two candidates, while on some of the policies, they're actually a little bit more similar than what people want to give them credit for. I think the biggest difference between current President Joe Biden and Donald Trump will probably be on the M&A side. President Trump will probably be more like a traditional Republican, allow more mergers and acquisitions, less regulatory pressure. Lena Khan would likely almost be certainly fired on day one, which could lead to more big deals or certainly more deals in the mergers and acquisition space. And obviously, if you're an investment bank like JP Morgan, that is music to their ears. Now, interestingly enough, from the dividend perspective, the company, as you'll see, is just absolutely doing great from a financial perspective, all things being considered in the banking sector. Well, they plan to do another increase on their common dividend for the second time this year. And that will give you a 19% cumulative increase on the dividend, which currently sits at about $4.60 per share right now, about a 2.2% yield. As those interest rates start to drop and you can't go just get a money market fund and earn 5%, well, these 2, 3, 4% yielding stocks will become more attractive from those income investors. So that's something to watch out as we move into kind of a rate cut cycle, how that will impact dividend paying stocks like JP Morgan. Now, when you look at the firm-wide revenue, it looks absolutely fantastic. We talked about $50.2 billion, 21.5% growth year over year, beating massively expectations, just absolutely tech-like. You flow all the way down to the net income. This is like Google and Apple, like $18.1 billion worth of net income. Folks, last quarter it was 13.4. Last year it was 14.5. We grew our net income year over year by over 25%, even outpacing the revenue growth, as the company's done a nice job on their non-interest expenses year over year, growing kind of those, that's salaried employees, those types of things, up 14% year over year, 4% quarter over quarter. Obviously, your net revenue is contributing to some of this net income. Now, a couple of things to note here. The very first thing we'll point out is the provisions for credit losses. Notice those are up 5% year over year. Provisions for credit losses, as most of you will know, is the money that JP Morgan is setting aside, waiting for people to default on their car loans, their credit card loans, their home loans, and any type of loan that they've given out. They have algorithms. They have people that make big time bucks that kind of project this going forward. And they're noticing that it's actually gotten worse, not only over the last year, about 5% worse. So as they set aside more money, they're anticipating more people to default. Look at the increase just quarter over quarter, up 62%. Just $1.9 billion set aside in Q1. Now, again, over $3 billion set aside. But there is something even more important to point out. We talked about how we had $50.2 billion in revenue. $18.1 billion worth of net income. This is fantastic. But the company recognized a nearly $8 billion net gain related to selling shares of Visa. So JP Morgan obviously had an investment there. Now, what they decided to do is they took $1 billion of that pre-tax gain and they set it aside. It looks like maybe they're starting some kind of foundation or some type of charity with $1 billion. So they're taking part of the nearly $7.9 billion worth of gain that they had selling Visa shares. They're going to put $1 billion of it to the side. But if you subtract that out, because again, this is a one-time thing, while it's great in the quarter and it certainly flows through to not only the company's financials, but shareholders as well, it is a one-time thing. Once you sell those shares, you can't get them back and resell them. This is not part of the company's normal operating business. You'll notice that Q2 net income was actually $13.1 billion. So if we strip out the gain on the shares of Visa, we are actually at, instead of being at $18.1 billion in net income, we're actually closer to $13.1 billion. Folks, that would actually be a decline over last quarter, and it would be a decline over last year. So stripping out those one-time gains on those Visa shares, our net income is moving in the wrong direction. And on top of that, we've got JP Morgan telegraphing low single digits to potentially negative revenue growth going forward. And obviously, as you have interest rates start to drop, you should have negative pressure on net interest income. That is the income the company can generate versus deposits versus loaning out, although you could offset that a little bit with higher demand. Now, in the consumer banking business, we are seeing higher demand. Look at your home lending, up 31% year over year, even up 11% quarter over quarter. There's a lot of pent-up demand in the housing market as people are looking at mortgage rates at 6, 7, 8, 9%, maybe even higher than that. If those walk back, you should see some increased demand here. But again, we're looking at a relatively small business for the company. Across the board, net revenue went to $17.7 billion. That was up just marginally year over year by about 3%, quarter over quarter, roughly flat. On the card side and automobiles, up 14%, but down 2% sequentially quarter over quarter. We come down to net income. Again, this is just your consumer banking. This is you and I with the credit cards and the home loans and the car loans. Well, that was actually down. Our net income down 21% year over year and down 13% quarter over quarter to $4.2 billion. You get your asset and your wealth management. This is what could potentially benefit a little bit. If you get a little bit of deregulation, a little bit more M&A, these types of things could benefit a little bit. Up 6% on the revenue side, net income up 3% year over year. Very steady business. We always see kind of a $1.2, $1.3 billion print here. Provisions for credit losses, certainly less than the consumer side, as those consumers have to rely on a job to pay back their bills. Look at your provision for credit losses, up 42% year over year and up 38% quarter over quarter. So they are seeing more and more consumers being hurt by the economy, defaulting on their card services and their home loans and automobile loans more and more. And again, from the corporate side, you saw a ballooning of the net income that was largely related to the fact that they divested away from some Visa shares and had a huge pre-tax gain on that. Now, technically, JP Morgan, I'm on a daily chart here. I'll switch it to a monthly chart so we get a really, really nice long view of this one. This one has been channeling up for a very long time. And typically, folks, when you get to the top of these channels, this is not necessarily a time where you want to step in and just load up on your JP Morgan shares. Now, could we bust out the top of these channels? Certainly, we've done it in the past, but I certainly wouldn't want to bet on it. These are areas where, look, if JP Morgan, it's been a great performing stock. If you want to take a couple of chips off the table, reallocate it into something. We're seeing small cap stocks absolutely soar over the past couple of days based on the anticipation of lower interest rates likely later this year. Rotate out of a JP Morgan into maybe something else. That's what you're looking for. Now, if you've been on the sidelines with JP Morgan, want to add to your position, look, you don't have to sell your shares. Just technically, I'm giving you kind of the technical perspective here. This is an area I think it's also supported somewhat fundamentally as well. As you look at the revenue growth going forward, I don't really see a lot that's going to get investors super excited here. And then when you have net interest income that's probably going to be under a little bit of pressure due to the lower interest rates, if it's not offset by demand, well, this company probably not going to excite investors too much. You get pullbacks, at least in the shorter term, south of, we'll call it 160, 165. Those are areas where you're absolutely stepping in. Your yield should tick up as this one pulls back as well. You start getting to 3.5%, 4%, 5% yield on a JP Morgan. Well, obviously this is a premier bank, premier investment, and this is one that you're absolutely looking to get into. So you can either continue to hold your shares of JP Morgan, or this is area actually really this week, next week, probably over the next couple of weeks. This is an area where you can shave off some of your allocation into JP Morgan, maybe go reallocate it into something that probably has slightly more upside over the next year. That's how you capture alpha. That's how you manage your portfolio. At least that's how the pros do it. You decide what you want to do, and you decide if you are going to show up later today here on the Investor Channel as we'll recap all the major FANG stocks for our FANG Stock Recap Show. I'll see you guys later today. Good luck with your investments.